Hi guys, today we will check out our short iron butterfly trade or iron fly trade. We will be selecting candlestick chart and we will be putting in Bollinger Band. Now the thing to note is that we need to get the Bollinger Band top line or top band to contract, to fall off. Example right here. It is now falling off. So if we would have traded right here, we had a higher chance of making money, because once it's contracting, it tells you that the lower volatility is here, it's coming, and once it is coming, it's a good time to make money. Now once it contracts, then even then we have a time to make money. So right here you can see Bollinger Band is rising. Let me zoom in for you. Right here it's rising. We put in one more day, it's rising. If you look at it right here, this middle band is the top band, this middle number, and this is the lower band, and this red number is this red line moving average. Now as you can see right here, the top band is at $830, $830.09. The next day it is $830.48, so it is rising. One more day, it's again rising. Now right here it's $831.15, but right here it's $830.46. So today is the first day that it's dropping, but we won't initiate the trade today. We will see if the trend follows. The next day we again look at it. Right here it's 830.46, but here it's 829.37. So this is the second close where the Bollinger Band have dropped, have contracted. So it tells us that there is something going in our favor. Now what do we do? Now right here we initiate our trades. Now in a iron fly, we initiate two put and call contract at the same price. And where will we put it? We will put it at today's price, or at today's price is $799.65, but we can put it till $795, till the middle line. So let's put it at $795, the middle line. This is our max profit line. I'm turning it green. Okay. Now let's put a second trade, options trade, which is our max loss trade. Right here. And we are putting it as a red line. Sorry, it's not coming up. Why? Let's check out. Okay. This is our max red line, which is where we lose money. Now as you can see, it's beyond the Bollinger Band. That's the reason we have put it, so that if it goes out of the way and comes to us, then this is the maximum loss that we attain. So Bollinger Band acts or like low volatility signal. As it is contracting, so we believe volatility will be low. That's why we have put in the mark or our trade as our loss point beyond that, because we believe if the price goes beyond that, then that's a dangerous sign. The same way, our second trade that we again put it on the Bollinger Band, because that's our max loss line. Now another day passes, it stays there. Another day passes, it stays there. It falls below our line, again falls below our line. Now as you can see, the Bollinger Band has really contracted. Really contracted. Now, the trade that we made was on this day. Okay? But now Bollinger Band has really contracted. So, our aim is if it goes beyond the Bollinger Band on the closing basis, on the top or on the bottom, then that acts as a telltale sign that there is something definitely wrong. So, our trade should be based on the Bollinger Band. Now, that green line is our max profit. And as we discussed in the previous chapter of time spread, once the trade goes through each and every day, the spread of premium starts to reduce. If you're making, let's presume, $10 premium right here, after 4 days it would have been reduced to $9.30. And it will continue to reduce. So you are making money each and every day. You're not trying to make the full money. My plan is not for the full money game. But my plan is for a sure money game. You have to make the money surely. You should not fall into any trap. You should make low money, small amount of money. But your focus should not be that you're like gambling. You should have a small amount of money as secure profit rather than risking everything and putting in a loss. So, right now 4 days have passed and we are in profit. And 5th day has passed, we are still in profit. 6th day, 7th day, 8th day, 9th day, 10 days. Now in 10 days we are in awesome profit on our line. But Bollinger Band has really come down. The volatility has really reduced. This is a brilliant sign but a problematic sign because it will not get stuck here for long periods of time. It will come out. So we will be vigilant. We won't risk our profit. Now this is 12th day. See, it has now gone beyond our price. 13th day, 14th, 15th. Again it has dropped. Now we have made 15-day awesome profit. We can book it. It's a good time to book it. But in our trading plan, you should have a plan to get out. I would recommend you to book it and get out. But I would also suggest you to follow a plan. Now you might be thinking I'm talking two different things. Now the first thing is to booking a profit. Now when I say that you should book a profit, I mean to say it's good to book a profit. But I'm not saying that throw your plan in a like waste bin. I'm saying do follow it. Do remember it. Now this is a good time. 15 days means you made awesome money. Book it, go home. But let's see if we don't book it, then what happens? 16th day up, 17th, 18th, 19th, 20th, 21, 22, 23rd day, we are in profit. 24th day, boom, problem. Now this is where we get to understand what really is happening. Now as you can see, we have designed our trade in such a way that it's a $35 difference from this green line to red line or trade, and it's a $35 difference from this green line to this red line. So we know that once it goes against us, we start to make go towards a break-even point or losses. Now right here at 8:15, this is the time to say bye-bye and get out of the trade. Now as we know, we would have attained the maximum loss at 8:31, but we are getting half point out. 815 means it's a $20 difference. We traded at $35 difference. So that's approximately 55% of our price. Now, as per my assumption, the break-even point will be around 823. Now, in our live trade, I will show you how the trade goes. But as we are discussing the general plan right now, so we are currently not focusing on profit or loss. What we are focusing at is our plan. Now, this is a time when our plan says get out, and you should get out and book your profits. Let's presume you are in loss. Then even I will tell you to get out. Even if you have a $5 loss, no problem. The point is to trade your plan. It will make you money. As you can see, we traded right here. It gave us money each and every time for so long. And now, right now, it's saying sell and make either book profit or book a small loss. But don't book a far larger loss. Now, I would recommend you to trade weekly options. Now, in a weekly option, it would have expired within 5 days. So you would have made money. You can trade again for 5 days, again for 5 days, again for 5 days. At the same strike levels and book profit each and every week. But once it goes out, book a loss, even if it is a loss. But don't book the max loss. As we discussed in the earlier lectures, that this is the maximum loss. But this is not the maximum loss. This is a far smaller loss because you have made money through premiums. So those premiums will get you more cushion to save losses. Now let me show you Google option chain. Now in the option chain, I will show you an option 30 days out and an option 5 days out. That is expiry date. An option with 30 days expiry and an option with 5 days expiry. Now what's my reason of putting you through telling you this? Today is 10th August, right? So 14th August, that is 10 days, or 15th August, that is 5 days expiry. Now this is an 8 days expiry from now. This is you make $23. Now today Google is trading at 940. So you make $22 if you put an put contract right at this price, and $2.50 in the call option. So you get to make $24, right? That $24 acts as your break-even point in today's term. If the options contract expire within the next 8 days, okay? If you make it 1 month from now, that would be September 10 to be exact. Now let me show you 1 month from now. Let's presume 8th September is good. So today's price is 940. So you get to keep a $16 right here and $11 right here. So that's $28 few cents. And initially the 8 days difference gave us a $24 difference. You get to keep $5 in your pocket if you expire it before 5-6 days earlier. Now that's the thing I'm talking about. If you get a $24 initial profit booking, that would have meant $820 as your break-even point. It's $815. So you get to keep a $5 difference. But even if it is not a profitable scene, it's a loss scene, but it will be a smaller loss. So I would suggest you to book the loss and get out of the trade. Why? Now let's presume we booked the trade. One scenario, we made it a profit, then it's good, it doesn't need anything extra. If we made a loss, small loss, let's presume $2 to $3. Now let's see what happens next. 1 day, 2 day it drops back, 3 days up, 4, 5, 6, 7, 8. Now as you can see, it has dropped back and is now going again straight. So you might be like thinking, why did I squared? The point is, usually if you look at Bollinger Band, it doesn't stick around the same level. Once it crosses, it goes beyond. Example, right here. Once it crossed, within 5 days, it was at a high point. And when you are placing a trade right here, let's presume at a 1 month onward period, this is August 19th, so it's September 19th would be here, it would be in profit. But let's presume you're putting a 2 month out trade. So once the trade reaches an end point, you start to make a loss. Now this is October 19th. Now October 19th, you can't do anything. It's at your loss level and you will be making a loss. Even though within that 2 month period your premium would have been far higher and you would have made good amount of money if you would have booked earlier. So never trust if the price goes beyond the Bollinger Band, because if it does, then you can get caught in a wrong period of time. And that's why I told you to square right here, either in loss or in profit. The reason being, in an options trade, the biggest enemy against you is the time spread. The time is getting finished. And on the last day, if the price jumps up and ends at your last red line where you traded your options contract, then you would need to book the maximum loss. So why risk everything? Why not book it before it goes out of your hand? So the one thing that our plan is based on, that you trade when the Bollinger Band is contracting, and when it goes out, you start to panic and get out. Second thing, trade weekly contracts. So if you trade it here and after 5 days it expires, then you make all the money. If you trade, let's presume second Friday, it would have expired right here. Still you would have made money. So try to make a trade with shorter time period in Iron Butterfly. Don't try to make on a longer time period, because your profit is on this line. If it goes a little above, you make money, but your profits get reduced. If it goes to red line, your losses comes into effect. So to save yourself from the maximum loss, if the price goes beyond Bollinger Band, you book your losses so that your losses are reduced. They are not to that same level. They are further reduced. And your profits will be far higher. So your losses will be so much negligible that you won't even see them. And that's what my trading plan is. That you need to focus on what is really happening, not on what the trade can max give you. Because even on the last day, as we discussed, if you would have traded here with 2 month expiry, then this day would have meant that on expiry we would have lost money. And this is the game problem, that on the last day it can just jump up and give you a max loss. Sorry, this is 18, this is 19. So the max loss would have been booked right here. It's a bit different, but even if it is not max and it's 90% of the loss, then even what's the difference? The point is to keep your losses short and keep your profits high. So right here we would have booked it and get out. so that we don't get caught into the max loss scene. And right here we would have made a break even point. And we would have the same capital in our hand to trade again. And the point of thing is, as we discussed earlier, right here, we could have booked it. And if you are trading weekly options, you could have booked your profit every week. So your profit gets booked, you make a new trade at the same levels and again book the profit every week. So your profits piles up and your losses are at break even. Then you start to generate a monthly income easily. That's the general term of my plan, and it works. I have made it work. My other students have made it work. So it's not just one person saying it works. It does work. Thank you.